Hey everyone, big news coming out of Washington, D.C. today. They want to borrow another $800 billion for just the final 3 months of the year. So, this is going to be big news because it still confirms this thought or this theory that no matter what happens, they cannot stop borrowing and spending all of this capital. When in reality, you guys have seen the debt metrics and how bad everything is going. So, today we're going to be watching a video on CNBC. They're going to be talking about this, and then we're going to kind of cover what this means because it's definitely not going to be good. Here we go.
Meantime, we have breaking news to Steve Leisman. Steve, what do you have?
Scott, the U.S. Treasury announcing its borrowing needs for the October to December quarter, saying they will be $776 billion. A little context on that. It's $76 billion below the prior estimate made in July. However, it is record borrowing still for that quarter. The October-December quarter was helped by revenues from deferred taxes in places like California and the IRS from some natural disasters that allowed them to defer taxes, and now they're being paid. It is offset, however, by slightly higher spending as well. On to the next quarter, the first estimate for the January to March quarter coming in at $816 billion, maybe a bit above some of the estimates I've seen on the street. That is record borrowing for the quarter. However, the Treasury is going to maintain a balance of $750 billion, a cash balance for both quarters. That's a bit higher than I thought, so that ends up increasing the amount the Treasury needs to borrow. We have seen some estimates of $700 billion cash balance. The Treasury maybe being a little more prudent given the way the politics are going, keeping a slightly higher cash balance. So 776, Scott, for the next quarter, and then for the first quarter of next year, $816 billion. Both are records. The first one down a little bit from the prior estimate.
Yeah, and bond yield's not moving all that much on that, Steve. It is one of two big events, though, this week from Treasury, right? And the biggie comes on Wednesday. And boy, there are so many investors who are focused on this refunding announcement from the Treasury, probably unlike any other announcement that they've made.
Yeah, the two announcements go in concert, Scott. This is how much, and then the next bit, which the market's really going to be focused in on, is how. At what tenors will the Treasury be borrowing? How much in bills? How much in coupons? What tenors in the coupons? 2, 5, 3, 7, or 10? Take your pick. 20 and 30, obviously, as well, going to be in the mix. So the market very interested in that. And we're in this phase right now where essentially the bond market and the yield on the 10-year is leading the stock market. And so there is some good news in this. We'll see what happens to revenue here, Scott. One of the economic puzzles out there is why has growth been so strong, but tax revenue been so weak?
Okay, before we get going, there's a few things I just want you guys to focus on. We're about pretty much halfway through the video here. We're asking for about $775 billion for just 3 months' time. That's a record. Never been that high before. The following 3 months here, going into January, over $800 billion, and that's going to be another record. We cannot stop spending. And if you guys think about it, this is supposed to be a booming economy, according to like the Treasury Secretary and the administration, so to speak. And even now, you guys just heard what's been happening. That we have this booming economy, but tax revenues are way, way down. What is exactly happening here? It's a conundrum.
Maybe it's going to come around and we will get some surprises on tax revenue. It won't change the overall picture, however, which is that the government needs to borrow an awful lot and borrow in record amounts.
Yeah. Yikes. Steve, thank you. Appreciate that very much. So maybe no big surprises.
Pleasure.
The market's near the highs of the day. Mike Santoli's with us right now. As I said, the issuance announcement.
More borrowing, more spending. That spending usually goes to Wall Street, not to Main Street.
Announcement on Wednesday is the one where a lot of folks are focused on, to the point where on halftime today I said to our investment committee, okay, big events this week, jobs report, Fed meeting, Apple. What's the biggest one to you? They said not on that list. It's the issuance announcement, because that's gotten people all worked up because of what it's done to bond yields.
Right, because from 3 months ago, people have learned the lesson that there's the capacity of this announcement when there's a lot of issuance at the longer end of the curve. Basically, the Treasury rather, attempting to force a lot of folks to buy duration, that was what hobbled the market. That's what got Treasury yields spring-loaded. I will point out 3 months ago, this equivalent announcement came in $250 billion above the prior estimate. So that was the upside surprise in overall supply in July. That coincided with the low in yields and the move we've had higher. So I would characterize today's news with regard to the equity rally as a bullet dodged. You know, we got ourselves worked up. We didn't have an immediate need to be incrementally worried. And now we'll see if this is more than just a bounce. What we're doing today in stocks is essentially mopping up the mess left by Thursday and Friday. We're not even back to Wednesday's highs.
But what do you think today is about in the real sense? I mean, you look at what's working. I said small caps are, they're lagging. They're trying to pick up a little bit of steam. You've got, big, widely held stocks like Tesla are lagging and lagging dramatically. But what's this about?
I think it's just about we pulled the rubber band pretty tight. And Fridays have been this occasion since the unrest in the Middle East, since the conflict started, to just get anxious ahead of a weekend. So we did see volatility bid. Look, we closed near yet another what could be support level, right? This area around 4,100. So it was a little bit of a make or break. We're oversold. How much more negative do you want to get? Also, we have no real earnings reports today. So all the stuff that got the market unsettled coming in, really not a lot of macro aside from the Treasury announcement. So I think it's very short term. You have to look at it in a narrow lens. And as I said, we're not back to Wednesday's close
Well, it's
yet.
good to have you here to put this into context, what Leisman was reporting.
Okay, right. So now I want to actually open up the stock market here so we can take a few looks at this, because what he's talking about is support levels, things like that. We are really mopping up. I think that's a pretty accurate way to talk about it. Let's go over here to the NASDAQ, and then we can talk about the SPY and other things out there. But basically, what I'm going to do over here is get out of my testing one and go back over here to the YouTube one. There we go. All right. So as far as the daily charts are concerned, we're still breaking down from those Fibonacci levels. We haven't really touched on to that 200 yet. So I'm pretty confident that we're probably going to continue to move down as far as the NASDAQ. We already blew through that support level here, okay? Now, the support level was right there. We closed down below it. Sure, we're bouncing back off, but we clearly closed down below it. A weekly chart also closed down below it. And of course, once we closed down below that Fibonacci level, we kept on going further and further and further. I think that overall trend is still going to be very much on the downward side. SPY, on the other hand, they're looking at a whole different level of support. Of course, we managed to break down right here, and what happened? Of course, we kept on going down. Unlike the NASDAQ, though, we managed to break down below that 50-week moving average. Support level is all the way down here, though, as far as we're looking at when it comes to the SPY, okay? That real support's going to be 404. I think what they're talking about right now is that support level. Not as really a strong level of support, if you ask me, but it's there, and it matters, right? So they're all hoping those types of moves occur. I want to go back over here to the daily chart. You're seeing those death crosses come. There's no stopping it now. So I do think there's going to be maybe one more bounce here as everybody tries to feel out what's happening with the market. After that occurs, I would be using those opportunities to start to short different stocks that you guys think are maybe overbought. These are going to be things that don't have earnings coming up pretty soon, that are just going to be relying on technical analysis. Because remember, death cross right there. The market kept on coming back down. Last time we had a death cross over here, it's been a while since we've had a death cross over the 200, hasn't it been? It was in 2022, death cross 1, death cross 2, and you can see right here the carnage that kind of came about. I don't think we're going to be as volatile as we were last year, but that overall downward trend should continue. And again, we don't have death crosses too often between the 2050s and the 200s. We don't really have them crossing back down. COVID was the last real big one besides the last year's. Before that, 2018, when they tried to raise rates. And before that, all the way back over here, in 2015, 2016, two bad events, right? But they're both buying opportunities. Now, zooming out a little bit more, you're like, whoa, each time it's been getting a little bit more violent, COVID exempt, of course. So just keep in mind, guys, everything is still in a very nasty downtrend. There's nothing going to fix this anytime soon, unless perhaps we figure out a ceasefire for the war that can maybe get oil prices to start coming back down. Because oil, as much as it's been coming down, right, it's still been having a pretty big pop, and it's still above those levels we were talking about back last summer, especially when July picked up right around here. That's when inflation started to tick back up, and you saw oil starting to roar back here. Hopefully, Israel conflict doesn't escalate. That's what's going to drive oil back up here within a freaking few days. All right. Today's video is sponsored by Fairdesk, a premier crypto exchange specializing in futures, spot, and copy trading.